Yeah, I mean, so far it's disappointing. And the reason, and Steve Weiss gave you a good teaser on it, I mean, they had a chance to tell us how bad the report was going to be, and it was pretty bad. They missed on the top and the bottom. But the fact that the Azure number came in at 40%, which sounds great, like, hey, we've got a 40% growth rate, the street was expecting 45 or 50. And if you want to carry a higher growth multiple, you need to be a growth stock. So PC sales were down, hardware was down. They'll have their earnings call at 5:30. So we'll learn a little bit more. You know, they're trying to do some damage control, I guess, right now to let us know that the corporate client is still there and still strong. It's not a reason to sell the stock by any means. We're not going to, but it's definitely a very disappointing report from our perspective. And on any bounces that we're going to get here, Scott, I'm going to be writing calls against it.
But I guess what I'm suggesting is maybe those headlines and others that will come out are reasons, forget about reasons to sell, reasons not to sell, and figure that, okay, we knew that currency was an issue, check, right? You told us that. We knew that PCs were weak, check. You told us that. We knew that Azure's growth at 40, was maybe it couldn't do 45 to 50%, 40% not that bad, and the enterprise, maybe it's holding up.
And you have a strong dividend, you have strong dividend growth, and you've got the Activision play, which broadens the field. Yeah, this isn't a reason to just run for the hills, but definitely when you're looking at a stock like this, you don't want to see disappointments. You don't want to see a miss. You want to see growth. And if we just listen to what Google, Alphabet said right before I came on, the CEO was talking about the FX, the currencies having a bigger effect because of the strong dollar, a more negative effect in Q3 and Q4. So we've got to kind of take that across the whole landscape, not just with Alphabet or Microsoft, but with all the big tech. And that was an important data point that we just got.
Okay, let's take it to fintech, if you want to do that. Visa, which you own as well. What's your read through here?
Yeah, the tale of two earnings reports. And I don't think we should be as surprised because we're also shareholders of Amex. We got some good numbers and some strong numbers out of American Express. Visa beat 198 versus 174. That's a strong beat. I was expecting $7 billion in revenue. They did 7.28. So also very impressive. But the big thing was 20% revenue growth was our target. They came in at 19%. So I'm very, very, very excited about that. We have to listen to the call because what do we want to know? We want to know about the health of the consumer. We want to know about the recession talk. We want to know about travel. Higher interest rates are certainly good for credit cards. The idea of the consumer having to lean more on that credit card over the holiday season also bodes well for the stock. Now, eventually that can become a problem, as we saw with AT&T in terms of people defaulting on their bills or paying things late. But for the short to intermediate term, all systems look go for Visa.
Yeah, I mean, we know the consumer at the lower end is obviously struggling. You don't need more evidence than Walmart to get that picture, and perhaps from some others too. Elsewhere, consumer seems to be holding up relatively well given the headwinds in the face.
Yeah, and I think they'll continue to do so throughout the end of the year, but it's Econ 101. The more we raise prices, the more sales are going to go down. And to your point about Walmart, it's the lower end of the consumer spectrum that's most affected by inflation. It's most affected by higher interest rates. So we know the Fed's going to give us 75 basis points tomorrow. They should do a lot more, but that's still going to help for sure. But this is a long road to recovery, and the consumer will suffer because these prices are just too darn high.
I got you. Kev, appreciate the time as always. That's Kevin Simpson, Capital Wealth, joining us today.